Good morning. I'd just like to do a short video to go through the solutions to assignment number 2. A number of you had some difficulties with this, and I thought perhaps this was the best way to show the answers from start to finish. I'm going to start with the second question because I wanted to lay out some work ahead of time to shorten the amount of time needed for this video. So pay attention and we'll work through and find out what the ideal answer is, and think of this as a learning experience. These things take some time and practice to get used to, so this is a good step to help you along that way, I hope. What I have done first is taken the information from the balance sheet in the question and set it out this way. So I have land and buildings. Now you'll notice I added a couple of accounts because I know I'm going to need them and they don't exist in the original balance sheet, so you have to add them as necessary. And I wanted to put them in a particular order, so I put in motor vans and cash, but both have a balance of 0, which is why they're not on the original statement. Okay, so let's go through each point in turn. The first thing is that inventories were sold for $11,000 in cash. Okay, so we'll do that first. Inventories for $11,000 in cash, so cash goes up by $11,000. And we had the inventories at a cost of $8,000, so inventories go down by $8,000. Now, at this point, we're only dealing with the balance sheet, so any kind of revenue or income type of question goes immediately into equity, which is what the hint was all about. So the $3,000 difference between what we got paid for the product and what the product costs, it essentially is profit. So that goes into equity. So equity increases by $3,000. Next is that we sold inventories for $23,000 on credit. So, and these inventories had cost $17,000. So $17,000, the inventories go down $17,000 more. We sold them on credit, which is trade receivables. So that goes up by $23,000. And the difference of $5,000 is added to the equity portion. Sorry, $6,000. The difference between $23,000 and $17,000, which is the profit level. So that's $6,000 into equity. We received cash from trade receivables totaling $18,000. So cash now goes up $16,000. 18,000, pardon me. It's too early. 18,000 cash, and trade receivables will go down by 18,000. The owners of the business invested $100,000 of their own money, which was placed in the business bank account. Now we don't really care where it was placed, but all we care about is that it's cash. So cash goes up $100,000. And since this is being brought in from outside the business, it's not part of the operating the business, the equity will increase by $100,000. So it goes directly into equity. The owners brought a motor van into the business valued at $10,000. When the owners bring an asset other than cash into the business, it's treated really in much the same way. Now we have a $10,000 value for motor vehicle, so motor vans go up $10,000. And that the offsetting value for that is an increase to equity, just the same as if you know, we just did cash, which is also an asset, and it goes directly into equity. So does this 10,000. We bought more inventory on credit for 14,000. So this is credit, which affects trade payables, 14,000. And 14,000 increase in inventories. And finally, we paid trade payables of 13. So trade payables go down 13,000. Sorry, trade payables, let me see. I made a mistake. Let me go back one step here. We bought inventories on credit for 14,000, and we added that to inventories here. It should be added here to the trade payables because they go up. In the last part, they go down 13,000. Okay, so that's the end of those discussions. So now you go through and you notice there's a few accounts here that have not been affected, so they carry automatically into the next balance sheet. But let's total these up and see what we have to work with. Motor vans are equal to, I'll put this in green, so motor vans equal to 10,000. Inventories add up to 17,000. Trade receivables, 38,000. Okay. When you add these up, of course, you have to start with the beginning balances, and everything gets added up across. Cash turns out to be 116,000. Equity is 119,000. Oh, sorry, that's, you have to add the, just as I said, you have to add the, equity is 322,000, that's a little better. And trade payables turn out to be 24,000. Okay, so if you remember those balances, I'm just going to collapse this into the balance sheet here. And I think I asked you to do a North American version off a classified balance sheet. So let's remember these. So those are the balance of accounts that we're going to use for the balance sheet. And it'll look like this. Have the balance sheet, and we start off with assets. And current assets are first of all cash, 116,000. Accounts receivable, $38,000. Inventory is 17,000. so the total of the current assets are, see if we can add this up quickly here. 15, 21, 7, and 1, I believe. Yeah. Okay. Fixed assets. Put land and buildings first. And there was no change to the fixed assets, or to land and buildings. They're still at 145,000. Have furniture and fixtures. Also no change. And we have the new motor vehicle at 10,000. Okay. So total fixed assets, 208, 218. And total assets are equal to 389. Okay, liabilities. The current liability is the account payable. Account payables were 24,000. And non-current or long-term liabilities was the bank loan. Sorry, let me, this was called a bank operating loan. A bank operating loan is a current liability, so let's move it into here as well. Bank operating loan. $43,000. So, and now the equity amount is added on. Equity is 322. So total liabilities plus equity is equal to 389. Make that a little nicer. And the balance sheet balances. Okay? So let's talk about question 1 of this assignment. Question 1 was to take the third year of the little shirt selling business that we started up. We were asked for the cash flow, the income statement, and the final balance sheet. So in terms of the cash flow, you're looking at, in terms of cash coming into the business, we have a beginning cash amount that was solved at the end of day 2 was our ending cash. So that's the beginning cash of day 3, and that was 255 euros. We sold more shirts, Okay, so we had 5 shirts left to sell at 15 euros a piece. So sales were 75 euros. Okay, for a total cash in of 330 euros. Cash out is, we have, remember, already paid for the shirts and the logos in the first 2 days. In fact, we paid them in the first day. So that cash was gone and taken into account then. So the only real payment that we have in terms of cash going out in day 3 is to repay the loan. So we have loan repayment of the 100 euros that we borrowed, plus we have interest on the loan of $10 or 10 euros. So out goes 110, and the total cash out so net cash is 220 euros. Okay, that's the cash flow. Let's do the income statement over here, and then we'll do the balance sheet in the end. Income statement. Revenues. We had sales of the shirts for $75, 75 euros, sorry. And the expenses are first of all, the shirt expenses. We sold 5 shirts. The original cost of those shirts was 5 euros each. So we have 25 euro shirt expense. The logo expense for 5 shirts was 5 euros. Okay, now notice that this doesn't matter when the cash was actually paid for those shirts and logos. That's one of the errors that a lot of people make, is they assume that there's no expenses because there's no cash going out. Okay, but we kept those in inventory at the end of day 2, and now they're being sold, so inventory is going to be cleared out. The other expense is interest. That gives us then a net income of 35 euros for day 3. Finally, remembering what the cash flow balance is there, the balance sheet becomes very simple in the end. The balance sheet is essentially made up of cash, 220 euros, and that's your total asset. We have no other assets in the business. All the shirts and logos have been sold, and we didn't purchase any more. So total assets are 220. And we have equity. We have no liabilities. So we have equity in the amount of 220 also. Now that calculation, this calculation, is the beginning equity was 185 euros. Okay, that was the equity amount that we had in on at the end of day 2, so we carry that forward, plus net income, 35 euros from up here, and it gives us our 220. Yeah. So total equity, total liabilities, and equity is 220. The balance sheet balances, and the partners, I suppose, can now take that 220 and split it up and use it to buy books or something for school. I suspect is what they're going to do. Okay, so any questions that you have about this, email me, let me know, and I'll try and explain it so that you can understand where you went wrong, if in fact you did on the assignment. Have a good day.